Welcome back to Startup Accounting 101. These are videos for founders to understand accounting fundamentals for running a business. We are continuing through the financial projections template. It is available for free from score.org. Just go to the template gallery and download the file. I'll have the link in the description below. This video, we are still on the financial ratios tab. The last video was an overview of the ratios, so please go back to that video if you need a refresher of those concepts. I'll link that video up here. In this video, we will now be looking at industry norms and performing a competitive analysis. So in the note here, sort of picking up where we left off, there is a column where you can enter industry norms. To get these, contact your local library or bank to see if you can get copies of the Risk Management Association RMA annual statement, or refer to industry publications and trade magazines. Speak with your mentor to ensure you're using the appropriate resources. All right, so I did that. I did a basic search on these annual statements. You could buy them direct. I think they're like $600 directly from their website. I did look at a couple of libraries close to me. So I'm based in Los Angeles. So I looked at the LA Public Library. There are copies at the Central Library downtown. The UCLA Library has copies up to maybe 2020, 2021. And so for me, I am no longer a student, and I'm also not going to trek downtown just to get a peek at these statements. So I am going with option number 3, which is to manually calculate the industry norms. And the good thing about publicly traded companies is that they have financials available to the public. As a candy bar company making business, I am going to compare my business against a company within the same industry. So for me, the publicly traded company that I've chosen to compare myself against is Hershey's. So I went to their website and I downloaded their 2024 annual report to get their financials. So here we have the income statement and the balance sheet. So I'm going to use these two financials, and we can see that Hershey's is a huge company. So the income statement here is in the thousands. So if you added 3 zeros, the Hershey's net income is $2 billion. So they're a multi-billion-dollar brand. But the good thing about the financial ratios is that they're relative to size. So I can still make a comparison based on the ratios. So I am going to split this up just so to show sort of where I'm getting the numbers from. I've already keyed in the numbers here, but I will we'll go through the ratios and I'll show you where I found them on the financials. So I'm going to show you the numbers, the quick calculation here, and then as a section, I'll provide some sort of analysis and commentary per section. So starting from the top, we have liquidity. So current and quick ratios, they come from the balance sheet. And I'm going to use the 2024 numbers for the analysis. So here we've got current assets over current liabilities. So we've got current assets here, which is about 3.7 million, over current liabilities, which is about 3.9 million here. And then with quick ratio, we have cash, or close to cash accounts, which are the first line, cash, and AR, both together, add those together, over current liabilities. So with Hershey's, the current ratio, they have roughly 1-to-1 ratio. They have just enough assets to cover all of their debts. So here you have three. It's almost a 1-to-1 ratio, and then the cash, it's about a 1-to-2 ratio. So for my small business, I'm beating them out 8 to 10 times the ratio. And as a new business, it just means that I just don't have a lot of debts, starting out with the business. So moving into the next section, which is safety and overall credit risk for the business. So on the Hershey side, we have total liabilities, which is 8.2, over total equity, which is down here, which is the total stockholders' equity. It's about 4.7. Then we have NOI, which is the net operating income. So if we come here, we do have net income. Unfortunately, there's no breakdown for depreciation, or they might be buried in the financials somewhere. So I just took the net income amount, and then that is over the total liabilities. And so if we see here, if I compare myself to Hershey's, they have a lot more liabilities. So if we go over here, they have a lot more liabilities, which actually makes sense for Hershey's. They're a much larger company. They probably have much better credit and a long-standing history with their vendors. So they're able to have a large, accounts payable. They're able to take on debt. They're probably able to take lines of credit or asset-based lines of credit because they have a lot of assets as collateral, essentially, for these debts. So moving down into overall profitability. So we're now looking at the income statement. So as a percentage, so we have sales growth. So taking the difference between net sales, the top line here, taking the difference divided by the 2023 number here, and then next we have the common size metrics. So we have COGS over sales here. We have basically gross margin over sales. Then they include payroll numbers into their COGS. So just to make it fair, I did the analysis down here. Like if we go back, so the COGS number is basically the total cost of goods sold plus payroll. That is all going to be part of the cost of sales for Hershey's. So I added these two together to create the numbers down here. So the COGS, to have a fair comparison, the COGS for my business would be roughly 60%, gross margin would then be 40%, and SG&A, which is essentially the operating expenses here, is 26%. So here, going back to Hershey's, SG&A is effectively these two. So sales, marketing, and administrative expenses here, plus I added the business realignment costs. So this section together over sales. And then the common size net profits would be down here. This net income over sales would be the net profit margin. So I guess we can talk about the section first. So for Hershey's, they're much more efficient with their costs. So I'm spending about 60% on COGS, and Hershey's is at 57%. Even their overhead or SG&A is lower. So my SG&A is 26%. Hershey's, it's 21%. So taking all of that together, my net profit right now is sitting at 9%, and Hershey's is at close to 20%. So they're almost twice, 2 times as profitable on a percentage basis as I am currently. And so running this competitive analysis, it's giving me goals to work towards. You know, it's challenging me as a business to maybe reduce my overall COGS and SG&A, and to find ways to increase the overall profit margin. I will say for Hershey's, again, they're a huge organization. You know, their COGS, they're able to buy and produce at scales, at multiple magnitudes. So their COGS, having less COGS, kind of makes sense. You know, they may be able to get better rates with their suppliers, or to have various discounts based on like bulk, huge like order volumes that I, as a very small artisanal, chocolate bar company, I just can't do that, at least right now. But, running this analysis, it just gives me a goal to work towards, that I can strive to double the overall profitability for my business. So moving on to the return on equity and return on assets metrics. So it's the same net income, so it's this $2.2 million number over either total assets, which is 12.9, or total equity, which is 4.1. Now, there's, I guess, the major difference would be ROA, return on assets. So Hershey's here, they have to invest in a lot of different types of assets to drive their sales. So some of that is PP&E, plant, property, equipment. They probably have their own manufacturing facilities, different warehouses. They also have a lot of intangibles. So you've got goodwill and other intangibles. They're probably making a lot of acquisitions. They have intellectual property, different trademarking. So there's a lot of investment that they have to make in with their assets in order to drive these sales. So I, right now, don't really have to do that. I'm mainly investing in like raw materials and inventory right now as I'm starting up the business. And the last metric, I left it blank because I really don't know how much the owners are. Plus, as a publicly traded company, the owners are the stockholders. So it's not really a applicable ratio to compare. So now we can move into the efficiency sections. So these days in receivables and days in inventory. So here we have, we have accounts receivable here, and then we have inventory. So this is 1.2. If we come back here, it's the sales and the COGS number that's coming into these ratios. So if we compare just the turnover ratios, they're actually pretty close. So right now, I'm spending about 20 days in receivables. Hershey's has about 25 days. Days in inventory, we've got 71, and then Hershey's is about 76. So they're about 5 days longer. But as a whole, given that they're a huge organization, they're going to have a more complicated supply chain and operations. So this tells me that it's actually comparable with Hershey's, these particular ratios. There's almost a negligible difference between both of the companies. And now looking at the very last ratio, we got sales to total assets. So we got the total sales number here, which is 11.2, over total assets, which is 12.9 here. Again, it's the same comment as return on assets. Obviously, they have a much lower sales to total assets because there's so much investment in all of these other assets. So although my candy bar business is much smaller than Hershey's, I can use these ratios to see how I compare against another company, how I stack up. And again, I can use some of these as goals that I can have for my business. And with that, we have covered a competitive analysis. The next video, we are covering diagnostic tools. Like and comment if you enjoyed this video. Please subscribe, and thanks for watching.